using philanthropic capital to de-risk investment capital. So the next panel is going to speak about exactly that. So we're going to have Adjei as a moderator, and she's going to have a conversation around what is working today, what are some of the things that are not working today for the investors that will be joining her, and then also what is the role of subsidies within that. So without much further ado,
Okay, so I hope everybody has a sense of the journey that we're trying to take you on today. So this morning, we started talking about the global landscape of impact investing, and maybe some of you were saying, so what? How does that affect me, where I sit? And then we talked about what it takes to actually unlock capital, and some investors were talking about marrying impact with financial returns, and hopefully that gave you some perspective on the realities that investors face. And we just heard from Vuyo, who gave us a very compelling perspective on what it takes for entrepreneurs to actually become successful. So we're going to turn to this question of building a pipeline. And Vuyo actually gave us, I think, a great challenge. He said, how do we create more Vuyo? What do we need to do so that we can sort of multiply, replicate his success story across the continent? And so I have with me on this panel today 3 hard-nosed investors who are struggling with that exact issue. First, I will introduce Adjei, who is the founder and CEO of Oasis Capital. He will share some very poignant stories around what it takes to actually build a pipeline of investments. And he was, before Oasis, a board member of Growth in Ghana, so has quite a bit of experience in West Africa. So, I'm going to introduce now Bierman, who is the CFO of Business Partners Limited, a specialist risk finance company for the SME sector. Business Partners is one of my favorite organizations. When I was in my previous organization, we worked with Business Partners to take them out of South Africa and into the rest of Africa. And then last but not least, Kola, Masha, who has a real passion for agriculture and has turned that passion in agriculture into an impact investment firm that focuses just on that space. And his vision is really around developing leading companies, agricultural companies. So obviously a very difficult journey for him, so he'll share some of those experiences. So welcome. So let me start with a question for all of you, and also feel free to share a little bit about what your particular company does, just so that people in the room can have some context of what you do. And that is, what have you learned about what it takes to successfully identify and invest in small and growing businesses, SMEs, even larger businesses that both have financial return and also are striving for some social impact? What are the lessons that you can share that would be insightful for this group?
The first comment I want to make is that there was a gentleman this morning here that talked about stroking and mutual stroking. And I think over lunch I spoke to Kola, and he's got such an inspiring story to share about what they do in Nigeria. So I hope you will allow us to do some stroking or some mutual stroking. First of all, I think what I need to share with you is that at BPL, and Emmy was right when she said initially that if it wasn't for the IFC challenging us that we should prove that our model can work outside of South Africa, we would probably have not done that. But our story and the lessons that we've learned in our operations in Africa is pretty much about the SME space. It's what our company has been doing for 30 years. It's lessons that we learned in South Africa that we took into Africa, and we learned some additional lessons there. And I'm happy to share some of them with you. But as I mentioned, we focus exclusively on SMEs. And if you look at the SME investment space, some of the lessons, or the most important ones we've learned, is that if you provide money to an SME and you do not provide some additional technical assistance, on the day that you disperse the money, start getting ready for your credit loss or your bad debt. Second lesson is that regardless how good your due diligence processes are, how extensive your due diligence processes are. If you do not spend time assessing the entrepreneur, and I think a few of the comments earlier actually touched on that as well, the person running the business is absolutely key. And you've got to find innovative ways and culturally sensitive ways to assess that individual that is ultimately going to run the business. You need to be fair as an investor. I think you need to be fair in what you expect as a return. You also need to be fair in the way that you actually get your return from those investors. But if you will allow me, let me get a bit more specific. We see 5 big obstacles to funding SMEs in South Africa as well as in Africa. There's first of all a very high a lack of collateral. So SMEs typically do not have that security that would make traditional bank financing viable. So one of the big challenges is to overcome the lack of collateral. There's a high cost of appraisal. If you do cash flow lending, you need to really get your head around the business, and you need to understand what the risks inherent to the business are. Thirdly, I think there's a high cost to the investment, and often that prevents the entrepreneur actually wanting to take up your funding, because if you have to do a risk-adjusted return, you often find that the cost of the investment itself will kill or suffocate the business in the early stages of its life, and one needs to overcome that challenge as well. There's often, we find that in South Africa, there's limited upside. Lifestyle businesses, a terminology that we coined, is the typical SME where you have a family-owned business that employs around 10 to 15 people. Those are the bread and butter investments that we do. We do about 400 or 500 of them per annum in South Africa. They do not generate the multiples and the returns that you typically expect from private equity or even venture capital. So if you have a limited upside, limited absolute return that is generated by the business, how can you as an investor expect to get a higher return than what the business can generate? And if those challenges are kept in mind, I can quickly share with you the lessons that we've learned in terms of overcoming them. Last one, lack of control. The entrepreneur needs to remain in control of his own business, in control of his own destiny. Small business individuals do not necessarily want to give up a part of their business, a part of their ownership. They fear the big institutions, the big banks, the typical financiers that will take over their business and start controlling the business. And we have to find solutions for these obstacles. And if you will indulge me, I'm not sure I'm doing on time, but I will run through them quickly. We developed a way to structure our investments as self-liquidating type of risk capital equity type investments. So in the lack of the secondary markets for exits, the structure of our investment does 2 primary things. It allows the business sufficient cash flow for the business to grow, but it also allows us a natural exit at the end of a 5 or 6 or 7 year period. And when I talk about that tenor, you'll immediately understand that as an SME investor, you need to be patient and wait for your returns. We also place a huge premium on leaving sufficient ownership in the business for the entrepreneur, even though we do take equity stakes in some cases. And I think our biggest success have arisen because of the way that we can do a comprehensive and a very detailed due diligence in a very cost-effective way. So we've got databases that we've developed about industry norms, and we were surprised to find how applicable the South African norms for specific industries in the retail sector, the manufacturing sector were as we took them out into Africa. So when you look at SMEs, when you look at those sort of businesses, the parameters that apply to them are basically universal. So it's not a South African specific norm in terms of margins, in terms of profitability, etc. So those expert systems assisted us in doing very effective and very quick due diligence processes. Another one I mentioned earlier, the mentoring and the consulting services or the technical assistance. We often find that the business has got, or the entrepreneur needs to have 3 skill sets. We talk about doing skills, we talk about technical skills, and we talk about entrepreneurial skills. If the entrepreneur doesn't have those entrepreneurial skills, or what we refer to as the passion, the commitment, the internal locus of control, those personality traits that tend to allow an entrepreneur to make a success of his business. If those skills are not present, we try and steer away from the opportunity. If the technical skills are lacking, we feel we can play a huge role in supporting and enhancing those technical skills. But we also place quite a big premium on the doing skills. If you are manufacturing food, know how to flip the hamburger patties. If you are in a manufacturing business, you need to know how to weld or whatever you might be doing. So those skill sets are tested, and we've done some cooperative work, collaborative work with the Entrepreneurial Finance Lab that used to be attached to the Kennedy School at Harvard in trying to assess it's a psychometric test that we use to assess the entrepreneurial skill sets and ability of the entrepreneur to try and lessen the cost of our due diligence and also to make the process much quicker. But in short, or in summary, I think the SME investments as a practice, it's not easy. I was speaking to Kola over lunch. There are much easier ways to make money. But what keeps us in this line, what keeps us excited about doing it, is you can see the impact that those businesses have on the communities in which they operate. And I think the example we saw just before this panel started, I mean, it remains inspiring. And that's what I think keeps fund managers like ourselves, and I think like Kola and them as well, to continue doing that work, because you can see the realistic and the very real impact that results from the work we do.
Thanks, Ben. I think the business partners model is very fascinating because it's a churn model. It really, in some ways, is impersonal because you have to move quickly in order to benefit from it and some economies of scale. But at the same time, you're able to tease out those entrepreneurs that are really going to be able to, first of all, return your capital and then also produce an impact. Paul, why don't we turn to you now, and maybe you could share some of the lessons that you've seen, maybe picking up on a bit on what Ben has shared, and also just to give us a bit of a regional perspective. Are we seeing, can we apply some of what Business Partners has seen in South Africa, where there seems to be quite a bit of opportunity, to a place like Nigeria?
The short answer to the question is yes. Quite frankly, I had an inspiring lunch with Ben, and we were quite fascinated how similar our businesses were, and learned quite a bit from their model. Fundamentally for us, I think probably it might be helpful if I first define from our standpoint as an impact investor what impact means to us. So for us, we look at impact quite simply. It's around economic growth and around helping provide a platform for disadvantaged individuals to raise themselves out of poverty. Because we fundamentally believe that is, Nigeria in particular, I think more broadly, Africa's one of its major challenges. Now, so for us as an impact investor, we, as we started thinking about what investments to do and so on and so forth, we struggled with really two trade-offs. The first is obviously scale. You want, whatever business you want to go into, you want to scale, because at the end of the day, if you don't scale, you can't provide a compelling investment return. And then the other trade-off is an impact at an individual level. Because if you want to create impact at an individual level, it doesn't actually lend itself to scale, because of the complexities involved, and so on and so forth. And so typically models at scale tend to have moderate to low individual impact, but as an aggregate, they have a lot of impact. So for us, we decided to focus on something that provided a happy medium, that provided us that scale, but at the same time had a large impact at an individual level. And we did that through a model, through leveraging franchising. Because we feel that franchising provides that unique opportunity where you can create a model that can have tremendous impact on an individual and transform an individual and literally lift them out of poverty. But because of the structured, simplistic model of franchising, you can replicate that thousands of times and hundreds of thousands of times and get to the scale that you're looking for. So to give you an example of how we've applied that. So we've applied that to the agriculture sector through what we call an agricultural franchise. So an agricultural franchise says we franchise grassroots level farmer organizations. And to those farmer organizations, in a typical franchisee-franchisor relationship, deliver services to them that enable them and their members to lift themselves up. So those services range from training, which I think Sven talked about is hands down the most critical piece. Secondly, credit. Without credit, and be able to create models that at the end of the day, the folks we will lend to don't have collateral. And so to be able to develop credit mechanisms that at the same time have terms that can meet the needs of the people you're investing in, but also mitigate the risks associated with that. And so we developed a very comprehensive 7 levels of risk mitigation that address all those critical risks. And then the third piece is then input delivery. Because if you provide training and you provide credit, particularly in the agriculture value chain is broken. And if you're unable to actually then not turn around and provide the necessary inputs to the folks so that they can be successful with the money that you provide them, I think as Ben said, you can start counting down to your default. And then the final step is also around markets. So we play a critical role in providing markets for the farmers that we invest in, and the farmers we invest in.
Thank you. Turning to you, Matthew, just what we've heard is, I think, there's a real focus on sort of the entire value chain and what the value chain looks like. Do you have some examples of scalable models as well, or are you seeing more of a piecemeal approach to finding successful investments?
Okay, thank you very much. In my particular case, I think the transactions that we've done specifically in 4 main sectors. And those 4 main sectors were carefully studied, and we consider them as essential services. And they are in housing, affordable housing, they are in education, hospitality, and health sectors. The way we saw in terms of how to get a deals and what type of deals are you looking for is for us to come out with our own model to say that most of these entrepreneurs are entrepreneurs of necessity. There's quite a few that are really very skillful because they're entrepreneurs of necessity because most of them were finding life difficult. They started something and suddenly they realized that there were opportunities. So at that time, we did not get, and it still is that you don't get too many people who are entrepreneurs and are also managers themselves. So we pick the entrepreneur and try to understand that you have the energy, you have the passion, you have the drive. Some of the businesses will be lifestyle, but we sit down with you and say, don't you think we can do A, B, C, D and grow up? And a typical example that I have is a school that somebody came to me and said, I'm setting up a school, and I said, how many students do you have now? They say 350. And I said, how much do you charge in a year? About $1,000 a year. I said, well, at your optimal level, what will be the total? I said, 750. So when I did my math, I realized that from my understanding of private education, your net margin is around 60 to 26%, depending on the type of curriculum you're running. So it doesn't make sense to me. And I said, well, if you had the same model in one locality and we can replicate it in other localities, how many schools do you think you can run? Then he brought me, after 6 weeks, a new business plan that is establishing a couple of schools within Accra. When we look at that, the numbers became more interesting, and we started the process and have, for the last 2 years, set up 2 schools already. We're doing a 3rd one now. His numbers have changed from just a little over $200,000 to over $1 million as of December. And that type of business is what is interesting to us. And it becomes interesting because we are entrepreneurs ourselves, and I have a couple of businesses myself. So what I do is that if we have that kind of discourse with them, then we will be able to help grow such businesses. The one point I want to make is also the fact that some of them see it as a lifestyle business. I've had a very tough challenge. There's one particular transaction I've negotiated with a person for close to a year now. And the sticky point was that the person was afraid of control, that coming in will change their lifestyle. That was the greatest fear. And what sort of lifestyle? So I got to a point where I had to negotiate his own compensation. And it was quite interesting that asking for a kind of pay, after I listened to him, I said, wow, I didn't realize I have Barclays CEO in front of me. Right. Right. So almost everything he wanted the company to fund. And his argument is that he also runs a school. He says it is a school that has financed everything that we have done throughout our lives. I do agree. But have you heard of the word dividend? Say, yeah, but because it belongs to us, we spend it anyway. I say, okay, we would find another way. So and I also want to make a point that it is important to be fair to the entrepreneurs. So we were very transparent, we put down the numbers, and we demonstrated to him that his lifestyle would not change with our coming in. The only thing is that instead of calling it allowances or salary or whatever form or drawings, you would now call it dividend. And once you can establish that and they see the returns that they will get vis-a-vis what you would get, so long as you are not making more returns than them, they are okay. And I think that is a fair deal. So it has helped us quite well.
Thank you. So I've heard that there are definitely scalable models out there. From you, Matthew, a real sense of really what it takes to actually work with an entrepreneur, taking him beyond where he was, and also examples of meeting entrepreneurs where they are. I want to turn now to the role of other types of finance, or capital rather, that enable you to actually do your operations, or work with, or in your case, create this franchising model. To what extent, and Ben, you mentioned this, that you must have some sort of soft capital, technical assistance, or something that is complementing the investment. To what extent is that important, and how do you ensure that you, and if it is important, to what extent, how do you actually marry investment capital with the need for other types of capital that will build the capacity of entrepreneurs, and how do you split your time to make sure you can do that effectively? Kola,
well, I think in the work that we do, and I think with most impact investors, the reality on the ground is that most of the businesses that they invest in are relatively new and innovative, and so the role of patient capital, soft capital, philanthropy, so on and so forth, is important to help enable these businesses to ride out the growth curve. But for us personally, what we want to always ensure is that that philanthropic capital does not make management lazy, because it can, and I think we've seen that in many scenarios. So we generally try to channel philanthropic capital into three key areas. The first is access to finance. The reality on the ground is that many of these businesses, the key role, I think, for philanthropic capital is to enable business models to prove themselves, to give them that cushion to prove themselves. I think the example that we saw before, where they got access to some debt that enabled them to develop, and then probably now I would assume that they would be able to go to an APSA or another bank and actually get financing to scale. So, for example, in our business, the way that we're addressing that is we've actually running a private placement for a bond. And so we call it a reach out of poverty bond. So it pays a good return to the investor, gives them nice metrics on how the money is used, and we've been fortunate to have 2 people subscribe to that already. Now, the second area that we believe we can play a role is that in many of these businesses, the management skill that is needed to incubate and get these businesses off the ground, the reality is that the businesses, because they're new and innovative, cannot generate the cash flows to support that. So to have a phase-out support mechanism that supports the cost of management and professional management, but at the same time ensures that it does not, as I said, make management lazy. And then very quickly, as the business scales, that support can be phased out. The third is the traditional area that in which this type of capital supports, and that's really training and development and human capacity development. But I think the caveat I'd like to say there is that really it's about helping these institutions and providing the capital to these institutions to build their own capacity to provide this training and to be sustainably develop, internally develop themselves versus relying on external sources. And that's kind of the model that we're trying to build.
So Ben, just in response to the way Kola's organization is using grant capital, philanthropic capital to fund the business model, do you see any risks in that? And how can, essentially we want to get to a space where philanthropic capital, grant capital isn't necessary, that these organizations can operate without that. How does that happen? What are the risks that it's going to be difficult to disentangle a need for dependence on philanthropic capital with investment capital? How do you see that risk, and how would you manage that kind of risk?
I mean, we take a slightly different approach because we truly believe that cheap funding is not going to solve an inefficient business. It is not going to make a business that is not sustainable by giving them cheap funding. The approach that we take is to first of all look at the growth path, the plan that the business has, and to ensure that the investor who typically takes the majority of the financial risk in our case, remains patient, remains with the business and do not require capital redemption terms, or you provide tenors that actually gives that business the opportunity to survive. Where we see a huge role for philanthropy, for grant funding, is in the way that we deploy technical assistance funds, because that, we believe, leaves a sustainable and a long-lasting legacy in the business by doing the training, by providing those technical skills to the entrepreneur that can ensure that once you take your mentor or your consultant out of the business, that skill set remains there and the business remains sustainable. Subsidies and grant funding, I think, from a personal perspective, it has a huge role to play in transforming systemic issues, in ensuring that some of the entrepreneurs, for whatever reason, that do not get the funding, because as a fund manager and as an investor ourselves, we've got a fairly good idea of where the probabilities lie in something that is not going to work. When I was listening to the story up front, I was sort of going through my mind and thought, if we had been approached by Bio and his team, would we have funded them? Because it's a fantastic story. It's a fantastic journey that they've done. But I just hope that if they had come through our criteria, that we would have funded it as well. I'm not sure. Because those are the ones that we might miss out on, that are inspiring stories and that we should have been funding maybe. But I think, just to get back to your point, the way that there's one key point that I want to make about technical assistance. When we provide technical assistance funding to an entrepreneur, we refuse to let him see it as a grant. By the fact that we expect him to repay the grant funding at some point in time in the future, we believe we bring three dimensions to the grant funding or to the technical assistance. We ensure that it's appropriate. We ensure that it's appreciated, because you pay for something. If you don't pay for something, you're not necessarily going to appreciate it as much. And thirdly, there's a natural dynamic that will ensure quality. If the entrepreneur pays for it, he's going to ensure that whatever advice he gets, he or she is going to be convinced that that advice is necessary and relevant. And ultimately, they will not sign off on the assignment, and we will not pay the service provider if the entrepreneur isn't happy. And in that way, you ensure that the grant funding gets recycled, because a lot of the entrepreneurs eventually end up paying it back. And with a $500,000 fund, we estimate we do about $700,000 to $800,000 worth of interventions in terms of technical assistance.
Great. So philanthropic capital that actually looks like investment capital from the perspective of the entrepreneur.
Apologies. Let me just clarify something. I want to make sure that when I make a comment about cheap capital, the reality is I don't believe that, like Ben, I fundamentally believe that a business, if it's getting capital that's below market rates, it's not actually sustainable. But what we are looking for out of philanthropy is to say, I think as the lady from Monitor talked about it, is that if many of these businesses in the early days, if you approach commercial lenders, the risk premium that they would put on it from a perceived risk standpoint would be too high to enable the business to sustain. And what the philanthropic capital provides, and for example the bond that we've raised, enables is that you can prove that the business model can work at this sustainable cost of capital. And that's really the way that we approach it.